These 8 states are quietly taking as much as $3,000 from retirees every single year, and most seniors have no idea they are even on the list. The list just got shorter in 2026. One state, West Virginia, finally ended its tax on Social Security benefits on the first day of January. That leaves 8 states that still collect money from your benefit check before you even see it. But here is the part nobody is telling you. Even in the states that just repealed the tax, some retirees are actually paying more this year than they did last year. Not less, more. Because a separate rule written into the federal code stacks on top of every state rule. And the combined effect in the wrong state can quietly take between $1 and $3,000 a year from a retiree's budget without ever showing up as a separate bill. Most retirees do not notice the charge because the state does not label it as a tax on Social Security. It is hidden inside the regular income tax return as a taxable portion of benefits. You only see it when you do the math, and when you do, it is often already too late to reverse the move that pushed you over the line. By the end of this video, you will know the exact 8 states still on the list for 2026, how each one decides whether your benefits are taxed, the 2 separate income thresholds the federal government uses on top of every state rule, the 1 new deduction Congress quietly added in 2025 that offsets part of the hit for anyone over 65, and the 5 moves that reduce or eliminate this exposure before the next tax year closes. Mark here, after more than a decade inside the financial system watching retirees get caught by rules nobody explained to them. Today's rule is one of the worst because it is invisible. Most retirees living in these 8 states do not even realize their state taxes Social Security until the year they end up owing. Therefore, the first move is knowing whether you are on the list. There are actually 2 completely different ways a state can reach into your benefit check. The first group is the simplest to explain. 4 of the 8 states apply a flat percentage to the portion of your Social Security that is already taxable at the federal level, regardless of how high or how low your total income is. Those 4 states are Colorado, Utah, Montana, and Minnesota. If you live in one of these 4 and any portion of your Social Security shows up as taxable on your federal return, the state will automatically take its share of it. Colorado is the most common trap because the state calls itself retirement-friendly. Colorado applies a flat 4.4% tax. Retirees age 65 and older can deduct the full federally taxable portion of their Social Security. That sounds simple, but the hidden part is this. Retirees between age 55 and age 64 can only deduct up to $75,000 of retirement income if single or $95,000 if married filing jointly. Therefore, any early retiree drawing Social Security before age 65, which is common for anyone who claimed at 62 to cover a gap year, gets hit with the full 4.4% on the taxable portion until the year they turn 65. For a couple drawing $30,000 a year in benefits with 85% of that benefit federally taxable, the Colorado hit before age 65 is over $1,000 a year, and most of them do not realize it until the return is filed. Consider the pattern of a Colorado couple in their early 60s. One spouse retired at 62 and started drawing Social Security early. The other is still working part-time for health coverage until Medicare begins. Their combined income sits just above the $75,000 single filer retirement deduction threshold because the working spouse's wages alone exceed the line. Therefore, the full 4.4% Colorado rate applies to the taxable portion of the early claimer's Social Security. Over the 3-year gap between early claiming and turning 65, the family pays over $3,000 in state tax on benefits that would have been fully exempt if the timing had been structured differently. That is money gone. None of it comes back when they turn 65. It is simply the cost of drawing Social Security in Colorado before the age threshold opens the full deduction. Utah is the next one. Utah applies a flat 4.5% tax on income. There is a Social Security benefits credit, but the credit phases out at higher income levels. Full exemption is available only for adjusted gross income under $54,000 for a single filer or $90,000 for a couple filing jointly. Therefore, the Utah retiree whose combined income from a pension, a part-time job, and required minimum distributions pushes them over the threshold loses the credit entirely. The math for a couple just over the $90,000 line can be as much as $1,400 a year in state tax on benefits that the federal government is already taxing up to 85% of. Montana taxes Social Security the same way the federal government does, which sounds straightforward until you realize Montana uses income thresholds that have not moved in years. The base amount is only $32,000 for a couple filing jointly or $25,000 for a single filer. Those thresholds were set decades ago and never indexed for inflation. Therefore, almost every Montana retiree with any outside income at all has up to 50% of their benefits pulled into the state tax calculation. And the Montana rate on that slice runs as high as 5.65%. For a couple drawing $28,000 of benefits with half of that pulled in, the Montana hit is close to $800 a year. Not catastrophic by itself, but it stacks on top of everything else. Minnesota is the fourth flat state, and also the most complicated. Minnesota allows a subtraction that fully exempts Social Security for couples with adjusted gross income under $18,320, or single filers under $84,490. Below those lines, you owe nothing. Above those lines, the subtraction begins to phase out and the state hit rises quickly. Approximately 29% of Minnesota beneficiaries still pay state tax on their benefits. That is nearly 1 in 3 retirees in the state, and the average hit for those in the phase-out zone lands between $2,200 and $2,200 a year. Therefore, if you live in Colorado, Utah, Montana, or Minnesota and your income is anywhere above the exemption lines I just gave you, the state is taking from your benefit check every year. Most retirees in these 4 states do not see a separate notice. The tax is built into the regular state income tax return, but the other 4 states work completely differently. The second group of 4 states is where the timing traps appear. Connecticut, New Mexico, Rhode Island, and Vermont do not apply a flat rate. They use adjusted gross income thresholds. If your income is below a certain number, none of your benefits are taxed. If your income crosses that number by even $1, the taxable portion opens up and the state starts collecting. The trap is that most retirees cross these thresholds not because of regular income, but because of a one-time event, a Roth conversion, a larger than usual required minimum distribution, the sale of a rental property, or a second home. Any single large taxable event in a single year can push a retiree over the line and trigger the state tax on benefits that were completely exempt the year before. Connecticut starts the taxation at $75,000 of federal adjusted gross income for a single filer or $100,000 for a couple filing jointly. Above that line, Connecticut taxes up to 25% of Social Security benefits at the state rate. That sounds like a cap, but the cap is on the percentage, not the dollar amount. Therefore, a couple with $120,000 of adjusted gross income and $36,000 of Social Security benefits will see up to $9,000 of those benefits pulled into state taxable income. And the state tax on that slice can approach $600. Consider the pattern of a Connecticut retiree at age 70. She had not paid any state tax on her Social Security for 6 years because her ordinary income stayed just below the $90,000 mark. In one calendar year, she decided to convert $60,000 from her traditional individual retirement account into a Roth account on the advice of a friend rather than a tax professional. The conversion added $60,000 to her adjusted gross income for that single year and pushed her over the $100,000 threshold. The state immediately opened up 25% of her benefits to Connecticut income tax. The additional state tax alone came to nearly $500 that year. But the bigger problem was that the same conversion pushed her federal combined income well past the 85% threshold, adding several thousand more to her federal return. If the conversion had been split across 3 smaller annual moves, each one staying under the state line, the tax would have been almost nothing. One phone call to a certified public accountant before the conversion would have changed the math. But by the time she filed her return, the year was closed and the move could not be undone. New Mexico has higher thresholds, which makes it easier to stay under. Single filers earning less than $100,000 or couples earning less than $150,000 can fully deduct their Social Security payments. But the moment income crosses those lines, the deduction disappears in full. There is no gradual phase-out in New Mexico for most filers. That creates what is often called a cliff. $1 over the threshold can cost hundreds in state tax because the deduction does not taper. It simply turns off. For a New Mexico retiree near the line, a single Roth conversion made without checking the year's income total can create a state tax bill on benefits that would have been exempt the year before and the year after. Rhode Island is the third in this group, and it uses a different test. The state only exempts Social Security for retirees who have reached full retirement age, which is 67 for most people approaching retirement now, and whose adjusted gross income is below $17,000 for most filing statuses, or $133,750 for a couple filing jointly. Therefore, a retiree claiming Social Security early at age 62 with the intent to take income before full retirement age is taxed by Rhode Island on the full federally taxable portion for those 5 years regardless of total income. The trap here is age-based, not income-based, and most early claimants do not know it applies. Vermont is the last state in the second group. Vermont fully exempts Social Security for joint filers with adjusted gross income of $70,000 or less, or single filers and those married filing separately at $55,000 or less. Between those lines and a higher phase-out threshold, a partial exemption applies. Above the higher line, the full federally taxable portion is taxed at Vermont's regular rate, which runs between 3.34% and 8.34% depending on total income. For a Vermont retiree who takes a partial year of extra income from a consulting job or a one-time distribution, the state hit on Social Security benefits can jump from $0 to nearly $1,500 in a single year. Therefore, the second group of 4 states, Connecticut, New Mexico, Rhode Island, and Vermont, creates a timing problem that the first group does not. You can live under the line for 10 years and then trigger the tax in a single bad year because of one decision you did not know was tied to Social Security at all. But here is the part that catches almost every retiree by surprise. Even if you live in one of the 42 states that does not tax Social Security, the federal government is still taxing up to 85% of your benefit. This rule is written into Internal Revenue Code Section 86, and it has been on the books since 1983. The problem is, the income thresholds that trigger the federal tax on Social Security have never been adjusted for inflation. Not once in over 40 years. Those federal thresholds are $25,000 of combined income for a single filer or $32,000 of combined income for a couple filing jointly. Combined income is defined as adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. Above the first threshold, up to 50% of benefits become federally taxable. Above a second threshold, $34,000 single or $44,000 joint, up to 85% of benefits become federally taxable. These numbers were set 4 decades ago. $1 at that time is worth roughly $3 today. Therefore, nearly every retiree with any meaningful outside income is now inside the 85% federal tax zone. The combined effect of a state tax on Social Security plus the federal tax on Social Security is where the real number appears. A couple in Vermont drawing $36,000 in benefits with combined income at $80,000 can see $30,600 of their benefits taxed federally, plus an additional state hit on the portion Vermont calculates. The federal tax alone on that taxable slice at the 22% bracket is over $6,700. The Vermont tax on top adds another $1,000 to $1,500. Therefore, the combined hit on Social Security benefits alone can exceed $8,000 a year, and most of that comes from the federal rule, not the state rule. Most retirees never separate the two in their own mind, and therefore never consider the moves that reduce the stack. Consider the pattern of a Minnesota couple in their mid-70s. They live in a paid-off house. They have a modest pension of $24,000 a year, and each receive Social Security. Their combined benefits come to $34,000 a year. Their required minimum distributions from a traditional individual retirement account add another $45,000. Their adjusted gross income comes in at roughly $13,000. They feel comfortable. They never thought of themselves as high income, but their combined income under the federal Social Security formula works out to well above the $44,000 second threshold, which means 85% of their benefits are federally taxable. On top of that, their $13,000 adjusted gross income sits just under the Minnesota subtraction threshold of $18,320, which means the state subtraction still applies this year. One larger distribution next year, triggered by a market gain that increases the account value used to calculate the required minimum, would push them over the line. The state tax on their benefits would jump from $0 to roughly $1,800 in a single year, and neither they nor their tax preparer would necessarily connect the dots to Social Security. They would see a higher state tax bill and not know why. But Congress did quietly add one offset in 2025 that almost no retiree has heard of. It is called the senior deduction, and it was signed into law as part of a 2025 federal tax update. The rule allows an additional $6,000 deduction for taxpayers age 65 and older on top of the regular standard deduction for tax years 2025 through 2028. For a married couple where both spouses are over 65, the combined additional deduction is $12,000. The senior deduction phases out at higher incomes. The full deduction is available for single filers with modified adjusted gross income at or below $75,000, or couples at or below $150,000. Above those numbers, the deduction begins to phase out and disappears completely at higher income levels. Therefore, middle-income retirees, the group most likely to be caught in the 85% federal tax zone, benefit the most from the new deduction. The Treasury Department has estimated that because of this deduction, roughly 88% of Social Security recipients now pay no federal tax on their benefits. But that statistic hides the truth for the other 12%. The 12% who do pay are generally the retirees with larger pensions, larger portfolios, and larger required minimum distributions. And for them, the senior deduction only offsets a portion of the hit. It does not eliminate it. And importantly, the senior deduction is federal only. It does not change the state rule in any of the 8 states we covered. Therefore, the full picture for a retiree in one of the 8 taxing states looks like this. The federal government taxes up to 85% of benefits on incomes above thresholds that have not moved since the Reagan administration. The state adds its own layer on top, and the new $6,000 senior deduction offsets part of the federal hit, but none of the state hit. A retiree who does not run these numbers every year is almost certainly paying somewhere between $1,000 and $3,000 more than necessary. The good news is there are 5 specific moves that reduce or eliminate exposure, and every one of them is legal, documented, and used by retirees who work with a tax professional. The first move is the threshold gap year. If you know you will have a low-income year, for example, the year between retiring and starting Social Security, that is the year to run any large Roth conversion, realize capital gains, or take extra retirement account withdrawals. The income falls below both the state and federal thresholds, the tax hit is minimal, and the assets are moved into accounts that will never trigger the Social Security tax rule again. A certified public accountant or enrolled agent can run the exact numbers for your state and your income before December. The second move is domicile review. Moving to a state that does not tax Social Security is not a quick fix. It requires a genuine domicile change, not just a second home. A tax attorney or a state tax professional should handle the actual filing if you do decide to move. For a retiree already considering relocation for family reasons, checking whether your destination state is one of the 42 that does not tax Social Security is a basic step. Arizona, Florida, Nevada, Pennsylvania, South Dakota, Tennessee, Texas, Washington, and Wyoming do not have a state income tax on retirement income at all. Each state has its own rules on what qualifies as domicile. The critical item here is that every state audits domicile in its own way. A driver's license, a voter registration, the state where your primary doctor practices, the state where your mail is delivered, and the number of days you actually sleep in the new state all count. Most states use a 183-day rule, meaning if you spend more than half the year in your old state, the old state still considers you a resident for tax purposes. Therefore, the retiree who moves to Florida in January but spends the summer back at the lake house in Minnesota can easily end up owing state tax in both states for the transition year. A tax attorney should walk through the specific domicile requirements before the move, not after. The third move is Roth conversion timing. For retirees living in Connecticut, New Mexico, Rhode Island, or Vermont, running a Roth conversion in a year your income was going to be near the state threshold anyway is an expensive mistake. Running the same conversion in a year your income is clearly under or clearly over the threshold is cheaper because it avoids the cliff or uses the cliff once instead of spreading it across multiple years. A certified financial planner or tax professional should model the multi-year impact before any conversion over $50,000. The fourth move is qualified charitable distributions. A qualified charitable distribution allows a retiree over age 70 and a half to send up to $18,000 per year in 2026 directly from an individual retirement account to a qualified charity. And that distribution does not count as taxable income. It satisfies the required minimum distribution, but keeps adjusted gross income lower. Therefore, the qualified charitable distribution can be the single most effective move for a retiree near a state threshold who was already planning to give to charity. A tax preparer or enrolled agent should set up the transfer correctly. If the money passes through the account holder first, the exclusion is lost. The fifth move is timing the required minimum distribution itself. Federal law requires the first required minimum distribution by April 1 of the year after you turn 73. Taking the first distribution in the year you turn 73 instead of delaying it to the April 1 of the following year spreads the distribution across 2 calendar years instead of stacking 2 into 1. For a retiree near a state Social Security threshold, that stacking effect can push combined income from below the line to above the line for a single year, triggering the state tax on benefits. Splitting the timing keeps each year's adjusted gross income cleaner. A tax professional should make this call based on projected income in both years. These 5 moves are all legal, all documented in the tax code, and all routinely used by retirees who sit down with a certified public accountant, an enrolled agent, or a tax attorney once a year. The common thread is that they require running numbers before December 31st, not after. Once the year closes, most of these moves are gone. The 8 states still taxing Social Security in 2026 are Colorado, Utah, Montana, Minnesota, Connecticut, New Mexico, Rhode Island, and Vermont. West Virginia just left the list. The federal government taxes up to 85% of benefits for every retiree above thresholds that have not been updated since 1983. The new senior deduction offsets part of the federal hit for most retirees, but none of the state hit. And the combined annual cost of ignoring these rules for a retiree in the wrong state with the wrong timing on a Roth conversion or a property sale is between $1,000 and $3,000 every single year, year after year, for the rest of your retirement. Your next step this week is to pull your most recent state tax return and look at the line that shows the taxable portion of Social Security benefits. If that line is above 0 and you live in one of the 8 states, you are on the list. The second step is to call a certified public accountant or enrolled agent before the end of the year and ask for a projection of your combined income against both the state and federal thresholds for the current tax year. The third step is to decide, based on that projection, whether any of the 5 moves applies to your situation. Act before December 31st.